Good morning, everybody. The September 1, 2015 School Land Board meeting will come to order. First item on the agenda is approval of the minutes from the August 4th, 2015 School Land Board meeting. After my colleagues on the board have had a chance to review, I could entertain a motion in a second.
So moved.
Second.
Motion is made, seconded, and carried unanimously to approve the minutes. Next item on the agenda is the approval of the consent agenda as posted. At this time, I'll ask my colleagues on the board to review, and assuming no objections, I could entertain a motion in a second.
So moved.
Seconded.
Motion is made, seconded, and carried unanimously to approve the consent agenda as posted. Items number 3 and 4 will be in executive session. Therefore, the School Land Board will enter into session pursuant to Chapter 551, Subchapter D, Section 551, Tech 071 of the Texas Government Code for discussion and consideration regarding pending or contemplated litigation and/or settlement offers, or to seek or receive attorney advice or counsel related to items 3 and 4 on the docket, and subsection 551, Tech 072 for the discussion and consideration concerning the purchase, sale, exchange, lease, or value of real property related to items 3 and 4 on the docket. Following executive session, we'll reconvene an open session to complete the docket. Open session of the September 1st, 2015 School Land Board meeting will resume with item number 3.
Good morning. Amber Long, Asset Management. Staff recommends approval of the disposition of permanent school fund land per the terms discussed in closed session as being in the best interest of the PSF. Any questions?
So moved.
Second.
Motion is made, seconded, and carried unanimously to approve item number 3. Next item on the agenda is number 4, as stated.
Amber Long, Asset Management again. Staff recommends approval of the disposition of permanent school fund land per the terms discussed in closed session on this tract as well, as being in the best interest of the permanent school fund. Any questions?
No. So moved.
Seconded.
Motion is made, seconded, and carried unanimously to approve item number 4. Next item on the agenda is number 5, as stated.
Thank you, Mr. Chairman. Members, for the record, I'm Rusty Martin, Chief Investment Officer. Before I start off with the report, I'd just like to point out that on August the 24th, the price of oil was about $38 a barrel. Yesterday it closed at $49 a barrel. It's down a couple of bucks today. So a lot of volatility, a lot of news going on around oil. I'm pleased to present you with a quarterly investment report of the TexGlo Permanent School Fund Real Assets Investment Portfolio for the period January 1 through March 31 of this year. The performance measurement calculations and statistical data that was presented in the QIR were prepared by State Street Bank and its Private Edge Group, which are the custodial, accounting, and performance measurement agents for the portfolio. I'm not going to spend a lot of time going over the economic data contained in the report, since it is as of the end of March 31 and a lot has happened since then. However, just briefly, the first quarter GDP decreased at an annual rate of minus 0.2% after increasing 2.2% in the fourth quarter of last year. Current consensus indicates that average annual GDP should be between 3 and 3.5% for all of 2015. Also, during the period, the unemployment rate fell to 5.5% from 5.6% the quarter before, and current consensus indicates that rate will probably average 5.5% for all of the year. Fed policy was really unchanged during the period. They left Fed funds rate unchanged at 0 to 0.25%. They maintained their policy of reinvesting principal payments from maturing agency mortgage-backed securities and rolling over maturing Treasury securities at new auctions. They also stated once again they would take a balanced approach when it finally does begin to raise rates, and they may keep the Fed funds target low even after unemployment and inflation are near mandate consistent levels if warranted by economic conditions. In the real estate markets, the NCREIF Property Index, NPI, posted positive returns for the 21st consecutive quarter. Fundamentals across all property types are benefiting from continued strength in the labor market, particularly in the office sector. All of the other main property types still reflected strong absorption rates, and vacancy rates were well below long-term averages. In addition, rents in a majority of markets were at or near their peak, and 1/3 of the markets experienced average annual rent growth of approximately 5% since 2009. As measured by NPI, The real estate market returned 3.57% for the quarter ended March 31st. Its trailing one-year return was 12.87%. All of the quarterly individual sector returns were positive for the 20th time since the second quarter of 2008. In the energy markets, WT oil ended down about 9% for the quarter at $48.66 a barrel. And that reflected, of course, OPEC, led by Saudi Arabia, remaining focused on preserving their market share during the period. The very strong U.S. dollar, a continued increase in U.S. shale oil production, despite a significant reduction in the rig count, and somewhat muted geopolitical unease. However, there was a declining in rig count at that time and significantly lower drilling budgets, and that should push U.S. production levels down to natural well decline rates over time. Gas prices also decreased during the period, ending at $2.64 a million BTUs. That was down about 16%. That was driven primarily by mild temperatures during the period and also continued supply growth. Oversupply is still a short-term concern, but in the medium to long-term range, there's still going to be significant coal to gas switching, and industrial consumption is going to increase, and LNG exports should start to come online, and infrastructure build-outs are going to come online also. Therefore, most market participants believe those factors will lead to a medium to long-term price of $3.50 to $4 a million BTU. In accordance with our strategy adopted in February of this year, the primary focus of the external portfolio was on potential investments and co-investments in the energy and infrastructure sectors, and also in accordance with that strategy, the internal portfolio was focused on dispositions. If you'll turn in your book to tab 2, page 2, we'll go over the numbers and start out by saying that the total net asset value at the end of March was about $4.4 billion. Of that, the external portfolio was about $1.9 billion, or 94% roughly of the portfolio. The internal portfolio was about $287 million, so around 6% of the portfolio. And the cash equivalents on hand was about $2.2 billion. Looking at the external portfolio performance during the period, which is the first section of that chart, you'll see that the current quarter for that return was 1.99%. That was underperforming the benchmark of 2.39% by about 40 basis points. That was almost exclusively related to the downturn in the energy markets and the effect on commodity prices. In the portfolio as invested, it's about 17% invested in the energy sector right now. That sector was down about 2.2%, and that's what caused the overall performance of the external portfolio to be below the benchmark. But looking at the 1-year, 3-year, and 5-year returns, you can see 1-year return 12.72 versus 8.55 on the benchmark, so outperforming the benchmark by over 400 basis points. 3-year return 14.15 versus 9.7, again outperforming the benchmark by 445 basis points. And the 5-year return on the portfolio 18.17% versus 12.21. So outperforming the benchmark by almost 600 basis points. At the end of the period, about 46% of our total capital commitments remained unfunded, 28% of the real estate, 59% of infrastructure, and 64% of energy. And that is as you would expect, since energy and infrastructure are where we've been adding commitments the past year and a half or so. Looking at the internal portfolio, as I said, which is about 6% of the total. The internal portfolio was a 2.58 versus 2.39 on the benchmark, so beat the benchmark. The 1-year return is 12.06 versus 8.55, and the internal portfolio has now experienced 17 consecutive quarters of positive returns. Looking at the returns on a combined basis, so combined portfolio performance without cash, for the current quarter is 2.06 versus 2.39 on the benchmark, so 33 basis points under. Again, that's caused by the decrease in oil prices primarily. But again, the 1-year return is 12.61 versus 8.55, so 406 basis points over the benchmark. 5-year return, 1509 versus 1221 on the benchmark, 288 basis points over. As far as diversification is concerned, on a property type basis, we are still generally over-allocated to real estate at this time, but that is going to change as more and more of the commitments to infrastructure and energy are funded. And geographically, we're pretty much right on track. The allocation to the U.S., excluding Texas, is about 79% of the portfolio versus a target of 75%. The allocation to Texas is 12% compared to a target of 15%, and the international allocation is about 9% compared to the target of 10%. That is the report. I'm happy to answer any questions. This is a non-voting item, by the way.
No questions at this time. This is a non-voting item, as Rusty had stated. Therefore, no further business standing before the School Land Board. We will go ahead and adjourn the meeting. Thank you, Rusty.
Thank you.